There's a silent wealth killer in Canada, and it's not inflation or market volatility or bad investments. It's unmanaged taxes. If you're a business owner, a professional, or an investor with significant assets, taxes are likely your biggest ongoing expense. But what separates the truly wealthy from everyone else isn't how much they earn, it's how they strategically manage what they keep. And in Canada, you don't need loopholes. You just need to understand the system better than most and act on it. Today, I'll walk you through the key tax strategies I use with high-income clients to legally reduce their tax burden and protect more of what they've built. Hi, I'm Danny Perro, Senior Investment Advisor at CG Wealth Management. I work with affluent Canadians, business owners, investors, and professionals who have done well financially, but who are tired of watching 40, 50, or even 54% of their income and investment gains disappear to the CRA. Here's the good news. You don't need to be aggressive to pay less tax. You just need a strategy that aligns your wealth with the tax system, not against it. Let's dive into how smart Canadians legally minimize their taxes across income investments, business structures, and estate planning. Strategy number 1, use your corporation for strategic income splitting and deferral. If you're a business owner, incorporated professional, or consultant, your corporation isn't just a place to run your business. It's one of the most powerful tax planning tools available to you in Canada. But here's the issue. Most high earners with corporations aren't using them to their full advantage. They're drawing income the same way year after year, leaving thousands or even hundreds of thousands on the table. Let's talk about what you should be doing. Income splitting, where it still works. Even with the CRA's tax on split income, TOSI rules, income splitting is still viable in many situations. Paying dividends to a spouse actively involved in the business. Distributing income to adult children in specific roles or with shares in the company. Using reasonable salaries to family members performing services in the business. Done properly, income splitting can lower your household tax bill significantly by lifting income from a higher earning individual to a lower earning family member. The key? Documentation, purpose, and timing. Number 2, income deferral. Many business owners don't realize they don't have to take out all their income every year. Instead, leaving retained earnings inside the corporation and benefiting from the small business tax rate, which can be as low as 12.2% in some provinces. That means your corporation earns $500,000 and you only need $150,000 to support your lifestyle. The remaining $350,000 can be invested inside the corp, used to fund future expansion, real estate purchases, or even insurance, deployed strategically later when your personal tax bracket may be lower. After retirement, for example, or a business sale. It's all about tax timing. You defer tax today so you can pay less later. Use a corporate investment account. If you're not reinvesting retained earnings, don't let them sit idle. A corporate investment account allows you to grow wealth inside your corporation, structure investments or capital gains and dividend income, use corporate class funds to control taxable distributions. Just be mindful of the passive income rules. Once passive income inside the corporation exceeds $50,000 a year, your small business tax rate starts to erode, which brings us to another tactic. Use a holdco to manage investment income and preserve your small business tax rate on your active income. Integrate insurance and estate strategies within the corporate structure for tax-efficient succession planning. Bottom line, you're incorporated and you're not using your corporation to strategically split income, defer tax, and structure long-term wealth. You're leaving opportunity and money on the table. A smart corporation isn't just about business. It's about building personal wealth efficiently and legally. Strategy number 2, maximize your TFSA and use it strategically. Let's be honest, many high net worth Canadians dismiss this. They dismiss the TFSA because it feels too small. The annual contribution room is capped. The balance doesn't move the needle on a 7-figure portfolio. But that's short-term thinking. The TFSA isn't just a savings vehicle. It's a tax-free growth machine. And when used intentionally, it can become one of the most powerful wealth building and tax-saving tools in your entire retirement strategy. 1, the real power is in the compounding tax-free. Every dollar you contribute to a TFSA grows completely tax-free. And more importantly, withdrawals tax-free too. That means no income tax, no capital gains tax, no dividend tax, and no tax reporting on withdrawals. Over time, especially when invested in growth-oriented or income-producing assets, a TFSA can compound into a 6 or 7-figure account, all protected from the CRA. And unlike our RSPs, TFSA withdrawals don't count towards income, meaning they don't affect your OAS eligibility, they don't increase your marginal tax rate, they don't trigger income-tested benefit reductions. That's incredibly valuable, especially in retirement. Number 2, invest like it's an opportunity, not a savings account. This is where most people, especially affluent investors, go wrong. They treat the TFSA like a high-interest savings account and park cash, earning only 2 or 3%. But if you're only using GICs in your TFSA or low-risk interest, you're wasting the potential. The better play, use your TFSAs for dividend-paying equities, REITs or income-producing ETFs, growth stocks with long-term appreciable assets, or even high-risk, higher-reward speculative plays. Since losses are contained and tax gains are free, think of it as the TFSA as one of the few places where you and the CRA don't share the upside. So load it up with your best growth ideas and protect the win. Number 3, integrate into your wealth withdrawal strategy. In retirement, the TFSA becomes a powerful tool to control your tax bracket. In a high income year, withdraw the TFSAs to supplement income, no tax impact. Need a lump sum for a property or family gift or a medical expense? Use your TFSA. It won't mess up your taxes or your taxable income. It won't trigger OAS clawback. Want to reduce taxable RSP RIF withdrawals? Withdraw from the RSP, contribute to the TFSA, and pull that tax-free money in retirement. This is how affluent Canadians use their TFSA to balance the overall exposure year over year and smooth out the retirement income without jumping between tax brackets. Strategy number 3, withdraw from your RSP early. Yes, early. This one surprises a lot of people, especially high net worth Canadians, because they've been told to leave the RSPs untouched for as long as possible. But here's the truth. If you built a significant RSP, waiting too long to touch it or use it can actually result in far more taxes paid. Let's break this down. 1, the myth, defer, defer, defer. We are told that the longer you keep your RSP invested, the better you are. After all, it's growing tax deferred, right? But that strategy assumes that your tax rate in retirement will be significantly lower than your taxes during your work years. For most affluent Canadians, that's not a reality. CPP and OAS add taxable income. You may still have rental or dividend income. RSPs convert to RIFs at age 71, triggering mandatory and increasing annual withdrawals. Those withdrawals are fully taxable and can push you into a higher tax bracket or trigger OAS clawbacks. Instead of saving taxes, you're just deferring them into a higher tax bracket. 2, the smarter approach, RSP melting. This strategy is simple in its concept, but powerful in its execution. You begin withdrawing from RSPs earlier, often in your 60s before CPP and OAS, or pension income begins. The goal is to withdraw at lower tax rates now, while your income is modest, smooth your income over time rather than spiking it in your 70s, reduce your RSP balance before mandatory RIF withdrawals begin, shift assets into a TFSA and a non-registered account where you have more tax control. Think of it as controlled drawdowns. You're taking a proactive approach to avoid getting boxed in later. Number 3, let's look at a real example. Say you retire at 60 with $1 million in your RSPs, but you don't withdraw any until 72. When you're forced to withdraw $75,000 annually, and your investment returns have pushed that balance up to $1.5 million. You're now paying higher taxes, triggering OAS clawbacks, risking a huge tax bill for your estate. But if you had started melting your RSP between age 60 and 70, or even modest withdrawals of $30,000 to $50,000 a year, you could have lowered your tax rate, protected your government benefits, reduced your estate future tax exposure, and shifted capital into a TFSA where future growth is tax-free. 4, why most people don't do this. Because it feels counterintuitive. We're wired to believe that not touching your RSPs is the responsible move, but real wealth management is about timing and efficiency and income coordination, not just deferral. Bottom line, if your RSP is 6 figures or 7 figures and you're not actively planning your withdrawals, you're deferring tax, not avoiding it. So ask yourself, would you rather pay a little tax now or give up thousands more in your 70s? Strategy number 4, use capital gains and dividends, not just interest. One of the biggest mistakes affluent Canadians make in retirement is assuming that all investment income is taxed equally. It's not. How your money is invested and where it's held can have a massive impact on how much tax you pay. Let's break it down. There are three main types of investment income in non-registered accounts. Number one, interest income, taxed at your full marginal tax rate. Number two, dividend income, taxed more favorably, especially if it's from Canadian eligible dividends. Number three, capital gains are the most tax efficient with only 50% of the gain that's taxable. Let's say you earn $100,000 from each type. Interest income, you could lose 40 to 54% to taxes. Dividends, you'll pay far less, especially after the dividend tax credit. Capital gains, only $50,000 of the $100,000 is taxable, making that the most efficient income stream by far. Now, here's the strategy that comes in. Most affluent Canadians have a mix of registered RSPs, TFSAs, and non-registered accounts, and often a corporation also. So the question becomes, which income types belong where? A smart asset allocation strategy might look like this. Hold interest-generating investments, GICs, bonds, high-yield savings inside your RSP or TFSA, where the tax is deferred or eliminated. Use your non-registered accounts for dividend-paying equities or growth-oriented investments that generate capital gains. If you're incorporated, use a corporate class fund structure to manage when and how gains or income are taxed inside your business. Why does this matter? Because you can have the same portfolio and the same return, but keep more of your money in your pockets just by structuring your income differently. Let's say you're withdrawing $100,000 per year from your investments. If it's mostly interest, you could be paying $45,000 in taxes. If it's a mix of capital gains, dividends, you might pay $20,000 to $25,000 or even less. That's a $20,000 difference per year for the same lifestyle, same income, and same market. Over 20 years in retirement, that's hundreds of thousands of dollars that you not had to pay to CRA. This is why high net worth portfolios must go beyond asset allocation. It's not just about what you invest in. It's about where, how, and when you draw from it. Tax smart income structuring is the difference between a good retirement and a great one. And it's one of the few ways to legally beat the CRA year after year. Strategy number 5, tax efficient gifting and legacy planning for the most affluent Canadians. Retirement isn't the end of wealth building. It's the beginning of your legacy strategy. You've built significant assets. You've paid your fair share. And now your focus shifts to something bigger. How do I pass on this wealth efficiently? How do I support my children or my grandchildren without triggering taxes or getting into tax traps? How do I leave a lasting impact with as little possible going to the CRA? Here's the truth. Without a proper estate and gifting strategy, a significant portion of your wealth could be lost unnecessarily to taxes. Lifetime gifting will help you while you're here. Many retirees want to help children buy a home, fund education, or grandkids, support causes that they care about, and they think, I'll leave it in my will. But that's where the miss happens. That's where the missed opportunity happens. Gifting while you're alive gives you more control, more impact, and potentially less tax. Why? Gifting reduces your estate size, which can lower your overall final tax bill and probate fees. You get to see the impact of your giving with your loved ones. You avoid the emotional, logistical complication that often comes with the estate transfer. Pro tip, if you're gifting to adult children, do it intentionally, not reactively. Use tools like trust structures or family loan arrangements to maintain control and protection. Life insurance as a tax-efficient estate tool. If you have large registered assets, RSPs, RIFs, or even corporately held investment portfolio, the tax bill on death can be enormous, 40 or 54% of the account value. That's where permanent life insurance comes in. You can use it to offset the future tax liability with a tax-free death benefit, pass on wealth outside of probate, leave more behind without increasing your tax bill today. If owned inside a corporation, the death benefit can be paid out tax-free to your estate via the capital dividend account or the CDA. Think of insurance not as protection, but as a wealth transfer strategy. Also, you can donate appreciated securities, not cash. If you're philanthropic, don't write a check. Instead, donate shares or ETFs that have increased in value. Now, why would you do this? Well, you get a donation receipt for the full fair market value. You avoid the capital gains, and the charity receives the same financial value as if you donated the cash. It's a triple win. You reduce your taxes, you support the cause, and you protect your portfolio. And if you're planning a major donation, consider using a donor-advised fund to control the timing and the legacy. Coordinate with your will and corporate structures. If you own a corporation, a holding company, or a family business, you need to integrate your legacy plan with you. Shareholder agreements, wills, life insurance, capital dividend planning, trusts, for example, family trusts or testamentary trusts. Without alignment, you risk double taxation, delays, and legal complications that can really erode the wealth you intended to pass on to your family. Legacy isn't just about giving, it's about giving smart. It's about making sure the wealth you work so hard for to build over the years goes to where you want it to go, not probate or unnecessary taxes, and not to chance. If you're an affluent Canadian, earning well, investing wisely, and sitting on years of disciplined savings, your single biggest opportunity now is tax efficiency. Not flashy, not exciting, but absolutely essential. Because it's not just about how much you earn, it's about how much you keep and how confidently you live knowing your wealth is working for you. And if you're ready to take control of your tax strategy and want a second opinion on how your wealth is structured, book a time with me using the link in the description below. Let's build a plan that protects what you built and gives you more freedom to enjoy it.